Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Lynn & Associates with your agriculture update for this Tuesday, and this is the 9th of May, and we're right now pushing 1:30 in the afternoon. So let's get some ideas as to what went on today. If we take a look at the wheat market, you can see down 4 cents on the day. So ever since we had that big problem a week ago, over a week ago now, where a lot of grain was lost in Kansas, we're still seeing pressure come on the market as world pressures are pretty big. The corn market tried a good rally today, didn't get too far, only closed up a half a cent on the day. What came alive was the meal and the soybean market. Now, interestingly, as these markets rallied a bit, the dollar very, very strong. So the dollar's acting as though that key reversal that we had, that outside day up yesterday, very important, putting pressure on that. A little pressure on the stock indices, not a lot, but the metal's still under a lot of pressure here. Even the coppers, which been beaten up, it got a bounce, but what, 25 points? That's nothing in the market. Look at how much you're down in the platinum. Then on the energy sector, which also looks at the dollar, and of course it's going to look at the API numbers today, they are under pressure in there as Libya's back online, Nigeria's oil is coming back online now, so more production is available there. But when we come to the weekly chart of the soybean market, what you've got, and by the way, I put up May. You should not be trading May. It's only because the May contract's live now, and then it'll roll over into the July. But this is still what the market has done, 1080 to 929 and 3/4. And when you go with weekly charts, it looks at the nearby contract to append all this data, and that's exactly what it's doing. When we look at the July chart and look at how it closed, well, it didn't get back over this 975. It did get up to 74 on the close, so now we'll find out what it can do here. Should prices break back under yesterday's low, and now that number is 964 3/4, this chart could look very ugly, and you could be headed back into the 950 area before you know what's going on. Market must start holding here, in other words. In the market, when you look at it with just the bar chart on it, not closes, you can see the funny action we've got going on. A hook down, came back, you get a bounce back into the zone, but what does it mean? Well, when I look at the swing line for the meaning of it, I'm not getting one. I'm getting still a higher high and a lower low pattern. Let's assume for a moment that the market takes out 983. No matter what it does, you still have the lower low. So I've got a lower low and then a higher high. Reverse that. Take out 963 1/4. You'll have lower highs and lower lows into a downtrend. Now, where's the 18-day average? Because that's the battleground right now. It's at 965 1/4, and look at what the market's doing. It's hit it 2 days in a row, bounced away from it. Should it get under 63 1/4, you would have lower highs, and at least at that moment, when you establish the lower low, you'd be under the 18-day average of closes. So that is one of the areas I think the pros are looking at. If the market extends its run, where might it run into resistance? Well, the run's been to the upside, so 78.5 could be the number, the upper Bollinger Band. Why? And that is because 95% of the time, these black bands act as support and resistance in a market, and the market will not close under or over it more than 5% of the time. And if you look at some markets, you get a feel to which ones act better with this rule than others. And it's just a visual take, but this is certainly one that likes the Bollinger Band theory. A lot of traders trade off of that, apparently. When we take a look at momentum, the momentum of the market is still pointing, trying to point up, but it's really more sideways than anything, as you can see, not really pointing one way or the other. Should it elect to point up by the red line jumping over the blue and pointing up, it'll do it immediately almost into an overbought area. It's all that you can say. The market's looking for direction. In the meal market, it's very similar. The market got up to the upper Bollinger Band back at the end of April. Since then, it's been hanging and hitting almost every day the 18-day average of closes. And what else? It's very evident you're in a sideways pattern. Now, you've got to think of this as a tube, and you got a spring, and you're winding it up in that tube. It's going to break out one way or the other out of that tube, and the longer the tube is, the stronger the breakout. You had that happen right here. See this action? And when it finally broke out, the market took off to the upside. Momentum at that point was much lower than you're at today, but it was here, and the market took off with it. Is this the beginning of upward momentum? You can't argue the market is trying to pick up some upward momentum. Can it get away from this, and what happens if it hits the 18-day average? As for a trend, there is none. You have a higher high and lower low, and with the close today, some upside bias because you're over the 18-day average of closes. In the soybean oil market, you have an overbought market, number one. It is in an uptrend. You've got higher lows and higher highs, but the market keeps running into this band and unable to really push. Let's assume it can. Well, then the 100-day average at 33.94 becomes a potential target. Let's assume the overbought condition makes the market pull back down. Well, if that occurs, 32.17 is the potential support. What you want to see is when that 18-day average rises tomorrow, how close it gets to 32.34. The problem to be a buyer in the market is no matter what you do, you're in an overbought condition, which is hard. In my opinion, the corn's still in a downtrend. You have a pattern of lower highs, lower lows. You're under the 18-day average of closes. All you did today is come back up to challenge it. Should you clear 365, a potential low could be the Bollinger Band bottom of 361. Momentum still pointing down. Wheat market into a downtrend. Lower highs, lower lows, under the 18-day average. Should the market get traction to the downside, you might be able to get to 413.75. On rallies, resistance is now 435.25, the 18-day average of closes. In the sugar market, sugar tried to rally, but more important, it embedded again. Now, what do I mean by embedded? There's a phenomenon that goes on in the slow stochastic oscillator where it can convert from being overbought or oversold into embedding, locking in a trend. I define that when you get 3 days in a row where the slow stochastic readings, the K and the blue, both have readings under 20. You got it today. You can see that. Yesterday, you had it, and the day before, you had it. Therefore, it's embedded. And now what happens is if the red line gets back over 20, odds will strongly favor the market moves back to the 18-day average. Doesn't mean it can't go higher. Cocoa did that recently, but that would be the objective. And you've had that happen recently. You had embedded readings, then you lost them, and that's what happened. But until they're lost, the market is still pointing downward. The bias is down, and if the market's going to fall lower, a potential support might be 1504. In the coffee market, battleground, 18-day average of closes. How often do I tell you that line in the sand? And here it is. So this market lost its embedded reading back here, rallied to the 18-day average, and it's been fighting at that number ever since. What is the trend right now? I'm going to define it as down. Lower highs, lower lows, price under the 18-day average. It can flip-flop on you like that if prices get over 137.10 because that could give you higher lows and then a high over that number, also over the 18-day average of closes. So I think the pro traders will play that market from both sides. They'll have a bearish bias until the market clears that number. In the cocoa, when you lost the embedded reading, and we'll come back to show this, you lose it here, pulls back down, just oversold, still hasn't hit the number. There's the objective. That doesn't mean it has to stop there, but that's the objective when you lose an embedded reading back here. If the market runs further, I'd say, well, resistance, another resistance point, maybe even up there. Here the market makes its move yesterday, stalling out at that today. Nothing has changed except you do not have a trend. You have an upside bias. You got a lower low and a higher high. You're over the 18-day average. You're overbought. If the market wants to punch through this upper Bollinger Band, maybe it can get to the 100-day average. If it pulls back, look for support at 1864. That would be how I define the market. In the cotton market, the market is closed higher today, and what you have is a higher high and a lower low. That is certainly not a trend. The market is oversold. It so far has been unable to get back to the Bollinger Band and the 100-day average. If it breaks, that could be potential support. If it rallies, I'd look for resistance at 78.47. But being oversold and trendless, I don't know what to do with that. In the cattle market today, you had a big break. Now, at one point it was limit down. It didn't quite close there, which is fine. You know, who cares? The market has still got the pattern of lower highs, lower lows. What set this all up was on this day, you were still embedded Friday. Yesterday, you lose it, and the market's higher. I realize that. I'm looking for price and the 18-day average to come together as a technician, and we'll see if that occurs. Because the bias is up and the swing line is down, I wouldn't know what to do with that as a trader, but I am telling people that if the market continues to fall, look for support at the 18-day average of closes. In the feeder cattle, same type of pattern, or is it? Not really. You have higher highs, higher lows. When you lost the embedded reading, and let's go to this one, you have it embedded there. On Friday, you lose it. When that occurs, because I was talking to all our meat traders, we have a lot of people that do meat hedging at Linden Associates. I was saying, because yesterday was such a strong update, they're going, yeah, so much for your idea that it's going to return and make an attempt at that 18-day average of closes. I don't look so bad today, so we'll see if it in fact does it. Now, admittedly, what does happen is the 18-day average is climbing a bit as the prices are falling to it. That's not what it's about. What it's about is being long is fraught with danger at that point. That's what it's all about, and it might return to that 18-day average of closes. The hogs are, wow. What do you say with a market that went from 67.75 without one day where it's got a lower low and got up to a high of 78.42? Unbelievable. That's an 1,100-point move, and every day here had a higher high. Unreal. None of them had lower lows. Isn't that pretty interesting? That's what happens when a market can just explode on you. Where was the signal for it? Okay, you want to come with me right here? Here is the market. Both numbers are under 20. Both under 20, agreed? Both under 20. Both under 20, and you lose it. My work would say you can't be short anymore because you're now oversold. You lost the embedded reading. Admittedly, you hit the 18-day average, so you're pretty, if you will, neutral on that. If it extends, the next objective could be the upper Bollinger Band and then the 100-day average of closes. That's how I'd be explaining it to my students and those that take my charting course. Now, I want to talk to you a moment, if I could, about my research. I'm doing something that I only do a couple of times a year, and it's for a short period. Should you decide that you'd like to try the research, use the word Ira 20. And you will get $20 off your first 30 days. And the subscription is not monthly. It runs every 30 days. It automatically renews. You can stop it whenever you want. But that first 30 days is on me. So how do you get this? Well, number one, what does it do might be the more important thing. In the morning, I start off with a video where I'm telling you where I think you can buy, where you can sell, the risk on it, how I think the pros are doing it, where they're coming from, the reasons why. I then write a report afterwards that you get about 11:30 in the morning, and I recap all the fundamentals of the day for you. At nighttime, I recap everything else that has happened and get you ready for the morning trade, and I put out specific recommendations. But that video really includes a lot. It's not on YouTube. It's nowhere that you can get. You have to be a subscriber. Call my staff. You can get it that way. Go to our website, www.iraepstein.com. Under the word Ira's Research, become a subscriber. Just type in Ira 20 when it opens. You'll get it. And there's a fact sheet there to tell you everything that's involved with that. Underneath us on some websites, you'll see click here for Ira's free offers, or you can click right up here if you're watching me on YouTube, and that'll take you right to the same area to sign up for all that. $20 off. You don't get it often. Take advantage. It's not going to last long. Take care now.